The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Welcome to the Senior Show. I'm your co-host, Neil Himmelstein. I'm here with Tim Kennedy.
Kennedy, yep. How are you? And Neil, who are we?
We are two wild and aging guys. Oh, boy. It's been a week, Tim. You're already messing it up.
Oh, my God. I can't take it anymore. I got to go home and practice at night.
What are you doing here? It's all good. Listen, I'm really glad that we're doing another show, Tim. We always have a good time. And, you know, it's always thought-provoking. I always leave the show thinking, wow, I didn't think about that. You know, so it's a good thing.
Yeah, well, you know, because these shows go so fast, and we try to cover a lot of stuff in a short period of time. And you're right. When we turn the mics off, we're like, oh, man, I forgot this. I forgot that.
That's all good.
But the truth of the matter is, all we need is for the listeners, if they can just get one piece of the puzzle or one nugget, just something that piques their interest.
Give us a call.
And they reach out to us and they give us a call.
Yeah.
And then we can point and direct them in the right way to get the help that they need.
Yep, absolutely. Absolutely.
Because what do we do, Neil? We help navigate change.
Yep.
With peace of mind and experience.
And change is happening every day. To you, to me, to everybody we know.
Yeah. So how does it feel to be a grandfather for 2 weeks?
Is it 2 weeks already? I think it's a week and a half. Yeah, maybe it's 2 weeks now. Absolutely. Yeah, it's it hasn't hit home yet.
Yeah.
Honestly.
Well, yeah.
It's life-changing. It's exciting. It's gratifying.
Mom and baby are doing well?
Everybody's doing well. Good. Thank you very much.
And everybody forgets about the father. So right. It's like, yeah.
No, it's okay.
Who's that guy?
I want to be in the background. It's not my show.
No, I didn't say the grandfather. I meant the father. The father. Yeah. Right. So.
Yeah. No. I get it. And the grandfather. Listen, it's not my show. I've had my shows.
You've been there, did that. Me too. Yeah.
And now it's okay. Let me sit back, observe, and help where I can,
and enjoy.
That's it. Absolutely.
It's a blessing.
It is. And you know, I was reading an article. It was an article called "Rethinking 65," and it questions this: Can you afford $250,000 in home care costs? It's a sobering reality. After 2 or 3 years of home care, that's $25 to $40 an hour costs can translate into, you know, six-figure annual expenses. And it's before considering taxes or liquidating assets or forcing your home to sale. Just take $250,000 and go, poof, where is it? And that's just at home. We're not talking about a facility, anything else.
And we throw that stat out there all the time, right? 70% of us are going to need some sort of long-term care later on in life, and for the majority of us, we're keeping our heads in the sand, and we're not focusing on that. So,
families can be forced to liquidate assets or sell the home, and usually when you're forced to sell a home, it's the wrong time.
It's the wrong time, right? Yeah.
It's always the wrong time when you're forced to sell something, and we deal with a lot of very wealthy people that, you know, didn't have an estate plan and they're forced to sell their businesses or buildings and at the worst time.
And they sell like as a fire sale, right? And where they if they planned it and had an exit strategy and did it right, they could have maximized what they could have gotten from that.
Correct. And now that a lot of them want to keep it in the family or keep their business in the family, and they can't afford to keep it running because they didn't plan right.
It's like a bank, Neil. Yep. When you go to the bank and you need money, they're not going to give it to you, right? They only give you money when you don't need it.
Exactly. So. Well, that's, you know, I love that movie, the Chris Farley movie. What was it? Where his father owned a brake shop. Tommy Boy. You ever see that movie?
Yeah, of course. Yeah.
You know, not only did I find it funny, but I thought in business planning, it really had a great thing because he was sitting with the bankers right after his dad died and said, "Hey, you know, we need money." You go, "But you're not Tom. You're not Big Tom."
Yeah.
You're Tommy. I mean, you know, Big Tom will get money anytime he asks. Tommy, yeah. No,
jury's still out on you.
You got to do something to earn that money. And that was a real story that hit home a lot of businesses and things, you know, besides being funny, and as many of his movies were, it hit home. So here's where it gets interesting. So one of the things that we do in my financial planning practice is we talk a lot about long-term care insurance. And it's not your traditional long-term care. And I heard it today. Again, it pisses me off. I yelled at somebody I shouldn't have yelled at. She says, I have this woman client who called me who's interested in long-term care, and she said it's expensive, right? And the advisor said, yes, it's expensive. No, wrong answer.
Expensive according to what? And what's plan B?
Yeah. So expensive is having to come up with this money to pay all these things. And so it just galls me because I have lawyers that say this all the time. The client will say, oh, should I get a long-term care? And the lawyer's first words out of the mouth is, oh, it's expensive. Expensive is a relative word.
Yeah. And
it just
Tell me about
bothers me that it's in people's head that it's expensive. It's expensive if you don't plan. It's not expensive if you do. And I was thinking about it today because somebody asked me to quote a 54-year-old for $1 million of insurance, for term insurance. Like, they do it all the time. I go, did you ever ask them about long-term care? Because it's funny because the average person or agent that comes to me that buys insurance, they're 50-year-olds or 60-year-olds or 70-year-olds. Like, oh, wait a minute. Don't you want to buy things when it's cheapest? Well, isn't it cheaper when you're 40 and 30 and 20? Why are you coming to me now? Because you didn't plan then.
Right.
And then I always get these calls, well, they really want to buy long-term care insurance. They're 74 years old.
Well, too late.
Can you get them anything?
Yeah.
Why are you asking me now when they're 74 years? Yeah. Did you ever have a conversation with your client when they were 64 or 54? Or did they ever think about it then? So we try, people say, well, why are you talking to me about this now? I don't have to think about it. No, you want to think about it when it's cheap and not expensive.
And you're healthy.
When you're older and you got things going on, it gets a little more expensive.
Not only expensive, but you may not even qualify.
So I'd rather you buy when it's cheaper.
I heard a great quote the other day. Neil. When we were younger, looking at houses and buying houses, what were we told? It's all about location.
Okay, right.
Right now, when we're older and we're on the cusp of possibly discussing retirement or in retirement or elbow deep in retirement, now it's all about cash flow, and cash flow. Right. So when you talk about long-term care being expensive, well, how expensive is it if you don't have it? And now you're paying all these aides $250,000 a year or $50 an hour. How expensive is that?
Right. And then, God forbid you need to go to a facility. And you're talking $500 a day. I mean, it's going to drain you. So long-term care is important. But let's get back to the house.
I love Neil, that's a great segue.
Yeah, no, really. I mean, people don't understand because the old school was, okay, shovel money into retirement. If you listened to my show last week, I talked about somebody who passed away, and he just kept shoveling money in retirement. And his kids are going to be taxed to all heck. He needed care and this and that. And again, did it the cheap way. Luckily, he didn't. I don't know if he paid for care out of his pocket or what he did. But whatever the situation is, the equity of his house, a multi-million-dollar house, and he could have just tapped that equity.
Neil, the stat today is homeowners over the age of 62 are carrying $14 trillion of home equity. And why are we not incorporating that into the retirement plans?
No, but I want to talk about when they're younger. See,
yes.
We only talk when they're 80 and 65.
Or 60s,
Let's talk about that. You turn 65, you can, without tapping into the equity of your house, just watch me. The way I understand it, if I'm wrong, tell me. Yep. I could take out a line of credit, not use it, but when I'm 70 or 75 or 80, when I really need that money.
How about 90, 95? Yeah.
Okay. That pot of money is growing. It's kind of fictitious money, but, when's the best time to borrow?
It's real when you need it.
When you need it, man. To have that tax-free bucket sitting there.
Yes.
For long-term care.
I have this conversation.
It's a great concept.
I have this conversation about 10, 15 times a day with clients about this line of credit, because this is the part of the reverse mortgage nobody talks about. You can borrow money three ways: lump sum, monthly payout, line of credit. I always push the line of credit because of that feature, the growth rate.
And the flexibility.
So, for example, I'll be 62. I would qualify for a $350,000 reverse mortgage line of credit at 62. I don't need the money. I plan on working, right? But I'm going to create this line of credit because that $350,000 line of credit in 10 years, when I'm 72, will most likely be almost double, almost $700,000. Well, guess what? If when I'm 82, that could be $1.2 million of tax-free money that I can now supplement my income and long-term care.
It's unbelievable. So if you need long-term care, and maybe you don't qualify for long-term care.
Well, there you go. Yes.
And now you got this pot of money to draw from down the road without losing your house. And that's a big thing because people think, oh, I'm going to lose my house. No.
No, it's your house.
Still yours.
Pay your taxes and insurance.
You got it.
Hey, we go on the break?
We're going to break.
Let's go to break.
The music's on.
You go first.
Okay, I'm Neil Himmelstein, Main Street Planning Group president and host of the Main Street Code for Financial Success. Best way to reach me, 631-647-4694.
Hey, and I'm Tim Kennedy, your certified reverse mortgage professional, and you can reach me at 516-729-6040. And if there's something Neil and I said today, please give us a call, and we'll point you in the right direction. And we'll be right back. We're going to break.
You got it. Welcome to the Senior Show. I'm here with Tim Kennedy, and this is Neil Himmelstein, co-host of the Senior Show. We are two wild and aging guys.
All right, that was better, Neil.
We're getting there.
Hey, so yes, I am the co-host with Neil. My name is Tim Kennedy. I am a certified reverse mortgage professional, and Neil's my co-host. Neil, why don't you take a second to introduce yourself?
Well, Neil Himmelstein, Main Street Planning Group. I do, life, disability, long-term care, annuities, but more importantly, I have a lot of attorneys that reach out to me because I'm going to read through the contracts. People don't understand that every contract is different, whether it's life insurance, whether maybe differences in mortgages, but I know that I pick up things just because I'm completely independent and I'm not brainwashed by some career insurance company just has you sell that. The idea is we want to fit the person to the right solution, not a product to the person.
Well, Neil, that's why our tagline for this show is helping you navigate change with experience and peace of mind, because we have the background and the connections to help you, the listeners, find what you need. There's 1,000,001 elder law and estate planning attorneys out there, but one may not float your boat, or you may not gel with that particular individual, but we can help you find that right person for you, for your personality and for your needs. Yeah,
it's not just the right person. You really want to look at first qualities, I think, when working with people is trust.
Bedside manner, right?
Bedside manner is important. You could be the best doctor in the world, but if you don't have bedside manner, you're not the best doctor. I knew somebody like that, and really, it's absolutely true. And also somebody's going to listen to your needs. I mean, I think it's critical. So if you feel that you're not being listened to, and that's a big problem with divorces or deaths, where the advisor may not connect with the surviving spouse. I'd say that happens more often than not, or when there's a divorce. I forgot who we had on the show. They were joking, but it was your friend with the mortgage company. I think she made a very valid point. The guy, or where did I read it somewhere? I don't know.
Well, the problem with divorce is nobody's happy, nobody's satisfied, nobody wins.
Right.
Either party doesn't win. Nobody's happy with their attorneys at the end of the result, so nobody wins. Right. The wife, the husband's attorney, the wife's attorney. Everybody loses. Nobody's happy because nobody got what they wanted.
Right. But we're getting off topic.
Yes.
What I wanted to talk about really are all reverse equity lines or all reverse mortgages equal? Is every company the same? Is there different guidelines? Is there different? I'm really curious because I know in the insurance world, everything is different. Every contract's different. So
every scenario is different because each individual is different. Now, I've been doing reverse mortgages since 2010, and every conversation has a different spin to it. It's not all cookie cutter.
Okay.
And there are different scenarios and different ways that a reverse mortgage can be used. Primarily, it's the home equity conversion mortgage that's managed by HUD, federally insured by FHA. But now we're coming out with more and more proprietary reverse mortgage products that is opening up this whole other side of business that we were never able to touch. For example, we were working with a client that had a $15 million home in Lower Manhattan. It was the home that Aaron Burr built for one of his wives.
Wow. That's crazy.
Pretty historic, right?
But how much home equity can you get out of a home like that? I know there's caps.
Well, in this scenario, a $15 million home, he capped at $4 million. He was able to pull out a $4 million reverse mortgage. Yeah.
I thought it was capped at like $650 or...
So that's the HECM. So the HECM, the home equity conversion mortgage, is the one that's managed by HUD, federally insured by FHA.
Right.
And there's a max claim amount of $1.2 million. So regardless of what your house is worth, we're using a value of 1.2, so you would get a percentage of that number based on your age. But with the proprietary, now the sky's the limit. We can use any value and maximize the equity in their homes.
I didn't know that.
Yeah, so it's a proprietary reverse mortgage. It's outside of HUD. It's outside of FHA, and it's a lot more flexible. New York is kind of strict with what the products they offer, but all the other states, they have proprietary reverse mortgage, second mortgages, fixed rate, adjustable rates. Yeah, it's crazy stuff now. There's so many different scenarios now that we're up against. The condos, in order to get a home equity conversion mortgage on a condo, the development has to be FHA approved. So what we're doing now is we're bypassing that altogether and just going right with the proprietary, because we don't need we don't follow those FHA guidelines.
We had that problem with clients a couple years ago. Yeah. And how about if they own? I know a lot of companies won't write if it's owned by a trust.
Yeah. So
and with all these living trusts going on, with all this estate planning, that can create a major hurdle.
Well. Here's the hurdle: when you put it into an irrevocable trust, you no longer own that home, right? The trust owns the home,
right?
So you can't call up a bank and get a home equity line of credit or a traditional conventional loan because you don't own the home. But with the reverse mortgage, because it's your primary residence, depending on the verbiage in the trust, you can qualify for a reverse mortgage.
Interesting.
And coordinate that with your trust. And basically what happens, the funds from the reverse mortgage do not go into your personal...
Go into the trust.
Bank, right. It goes into the family trust bank account. And, the simplest way I can say it is when it comes to Medicaid, if you can touch the money, so can Medicaid. In this scenario, the money goes into the trust and it's protected.
Which is why irrevocable life insurance trusts are so huge, especially for high net worth or for other reasons. We use them all the time. And we use irrevocable, and we're starting to use revocable.
Well, yeah.
But we use irrevocable life insurance trusts because no matter what the death benefit value is, if it's purchased by a trust, it's outside your estate and is therefore not estate taxable. It's a huge, huge deal. And, the average advisor may or may not understand that. And it's a very important planning tool in what we do with life insurance.
Hey, listen, I love this country. I love the United States of America. It's a great country. I pay a lot of taxes.
Yeah, we both do.
But I don't want to pay any more taxes than I have to.
Right.
And if there are products or solutions out there that I can hold on to as much money as I possibly can, I want to hold on to as much money as I possibly can.
Well, it's what you have to understand is with taxes in retirement and taxes in retirement, you have a partner in every dollar you touch. And sometimes you want to pay the partner, sometimes you don't. But I don't mean it like that. It's like it's not a partner that's working with you necessarily.
Well, it's mismanaged funds.
It's for the global good, supposedly. But you gotta live from 60 to 70 and 70 to 80 and 80 to 90, and having that piece cut out of every penny is difficult. Now we have some clients worth well in excess of $100 million. And I guarantee you the tax rate they're paying for most of the ones that I've seen recently, they're not paying any taxes. And because they understand all the different tax provisions and find ways of not paying taxes. And you could say, well, that's not fair, it's not right, and I'm not getting political, but they're taking advantage of every tax advantage program that they can so that they can keep it as much money as they want.
But even for the average or above average or slightly more affluent homeowner, which
Right.
is right, there are still a significant amount of products out there that they can use to hold on to a pretty good percentage of their money,
Right.
and leave a significant legacy to their children.
And exactly. Now, I talk about immediate annuities of money you can't outlive. What people don't realize is the older you are, the less tax you pay on that money, because a lot of it's taxed as principal. So it's a very tax-efficient vehicle, especially if you're 80 or 85. I mean, you basically pay no taxes and maybe get 15% returns on your money or 12% returns. But it's your own money plus
That's right.
some interest.
Hey, let's continue this conversation, Neil.
Sure.
Can we remember this for next? Can we write this down and we'll continue this
my
conversation for
goodness.
next Monday?
Next Monday? That's a whole week from now.
All right,
You
all right,
kidding
Neil.
me?
I'll write it down.
All right, you got it. Anyhow, you've been listening to The Senior Show with your co-hosts Neil Himmelstein and Tim. And Tim, give us the sign-off.
Hey, Tim Kennedy here, your certified reverse mortgage professional. You can reach me at 516-729-6040, or you can reach me at timtalksreverse.com. Hopefully you got something out of the show today. And Neil?
Best way to reach me, 631-647-4694. You can catch our shows on Spotify or Apple, or give me a call, or visit me and do what you got to do. 631-647-4694. Have a great week, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.